What's interesting is over the past weekend, I've had quite a few people reach out to me and ask me, what do I think about what's going on? Now, the first thing I always say to anyone that asks me this question is, it doesn't really matter what I think. What matters is, based on the information that's coming from the market, what can we do with that information? Okay, how can it be of value? It's very easy. And I take the example, over on Twitter over the weekend, we're seeing a lot of, market practitioners coming out and giving their view, giving their opinion. Just go with the GameStop, buy GameStop, and get long silver, and go buy the ETF in SLV. But the reality is, as traders, we always have to manage risk. Okay. There doesn't exist a professional trader today that I know that doesn't manage risk first and foremost. Okay, so that's the reality. Now, yes, GameStop's moving around. Yes, we've come in this morning and silver's up 10%, on the close from Friday. These are realities. This is information that's coming from the market. But the point is, and this is the purpose of the stream, is I want to give you a little bit of understanding, but then more importantly, show you what you can do with that understanding and how you can profit from it. Okay, and very often it's not straightforward. It's not what you think is the straightforward trade that ultimately makes you money. It's the trades in and around that, and that's what the stream's going to be about, just to give you a little bit of some advice, and hopefully you can make some money out of it this week and further your career. So, I'm not going to talk much about GameStop. Because you should all be aware of it, okay? If you're not aware of it and you're not reading what's going on, get up to grips with it, because there are repercussions of what we're seeing in the likes of GameStop and the silver market early on Monday morning. Now, what's happened? I'm not going to get into too much of it, I'm not about opinions, okay? Opinions don't add value to us as traders. What's important are the objective facts. Now, what we can see, and the best place to start off is, we're going to get onto the charts in a minute, but what we can see is there was an impact, okay? There was a GameStop, a GME impact last week, all right? We can see that in the volatility. We can see it in the fact that the equities, the US equities were down over 3%. We can see it in the fact that, markets were generally quite volatile across the board the moment GME became volatile, okay? Now, there's three things we're going to talk about in the stream, and I'm not going to keep it long because the reality is you've got things to do. You've got to focus on what's at hand at the moment. Now, we're going to talk briefly about that GME impact and what it means, but also have a look at the key things that came as a result of that GME movement last week. We're then going to talk a little bit about SLV. Right? I'm going to kind of pull the wool in front of your eyes and show you the reality of what you could potentially see this week. And then we're going to talk opportunity scope. Okay, I'm going to show you where the easy opportunities are, the opportunities that maybe you haven't thought about, and hopefully you'll start to get an understanding of how professional traders will treat a volatile situation like this. Okay, so let's get into it. And where we're going to start is we're going to go onto the chart of GME. Now, what you're looking at here is Reuters. You're looking at a three-pronged chart, okay? In the bottom, in the purple is GME. Now, the reason I've got GME on this chart, what we've got here, we've got GME in purple, we've got the S&P 500 in orange, and we've got the VIX, the volatility index, in green. Now, the reason I've put these three markers is to show you the impact that GME had on the bigger markets. Okay, GME in terms of valuation is tiny. Okay, it's a very small valuation, but because a lot of leveraged positions came unstuck last week. Okay, we know there's 140% short interest in the market. So because there's a lot of leverage there, we saw that flow over into some of the bigger markets. Okay. Now, the reality is, and again, this is why I say we've got to be objective as traders, not get sucked into the moment, not get sucked into the Vegas lights. Yes, GME was doing 100% opens and closes and all sorts of crazy things. But the reality and the honest truth, guys, is that you cannot manage the risk in those situations, okay? I had to field 3 times this weekend. I had to field the question of, you must have made a lot of money in GME. And the simple answer was no. In actual fact, I lost money last week. Okay? Go ask my broker, he'll tell you, I lost money last week. In fact, I had a horrible week last week, right? Why? Well, because the reality is I was trying to impose myself onto the market rather than letting the market tell me what the real opportunities were. Okay? Now, yes, you could have bought GME. Yes, you could have doubled up your money. But the reality is traders that are trading any kind of size, that are actually managing money properly, have to manage risk first and foremost. Okay? And the reality is when a market's moving 100%, you cannot manage risk. Okay? When a market is dropping 25%, it's very, very difficult to manage the risk in that situation. Of course, as traders, we have a punt. Of course we do. We've all got IG trading accounts and interactive brokerage accounts so that we can have these punts where we buy a couple of hundred shares and have a shits and giggle approach. But the reality is that's not where traders or professional traders make their money. That's the honest truth, guys. Okay. So what can we do about it? Where are we going to make our money this week? Where is it that professional traders are sort of zoning in on this week? Okay. Well, we know as a fact, not my opinion, per the chart, what you can see, when we had GME volatility, i.e. we gapped open on the 27th of Jan, i.e. Wednesday. Okay. Note we gapped and we moved sideways. Because of that higher price gap, what did we see the VIX do on the day? We saw the VIX in green. We saw the VIX move up. Okay, so there was more volatility coming into the market as a result of the volatility in GME. At the same time, we saw the S&P 500 drift lower. Okay, we dropped almost 100 odd handles on Wednesday trading session. We then had the gap up. Okay, the next session was Thursday. We had the gap up. All right, I remember it was just shy of $500. And GME sold off from $500 all the way down to the $80 mark. Why? Because obviously we saw Robinhood brokers shutting down how much you could buy. We all know the story, okay? But the reality is, what did that do for the markets? We understand. Well, we can see the VIX dropped off, okay? Notice what the VIX did. It went from all the way from 35 down to 27. All right, that's a significant drop. At the same time, the S&P recovered. Right? We then came in on the Friday, and what did we see? Market gapped up again. Okay, so that volatility came back. What did we see the VIX do? Higher. What did we see the S&P do? Lower. Okay, so you get where I'm going with this. GME isn't the easy option. GME is just the sort of indicator. Okay, if GME is volatile, it means it's going to spread out into the other markets. Right? Now we can see that this morning GME last I checked up 10% on the overnight market, so nothing, no significance. Right? So it adds no value to our thesis at this point in time. Now it's not to say GME doesn't go flying today, but notice what we're using GME for. We're not using GME to trade. We're using it as a proxy market for risk, for the S&P 500, NASDAQ, Russell, whatever you're trading in the US equities. Okay, we're using it as a proxy for volatility and subsequently opportunity. Okay, next up, let's go on to the SLV. This is the new topic. This is this week's narrative. Okay, bang, we got GME, we squeezed out a few shorts, Malvern Capital's dropped 56%, blah, 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 blah. Who gives a shit? That's the reality. No one gives a shit. Okay, what we care about is the implications of what is going to happen should the silver maintain its current volatility. That's where the opportunity is. Now, yes, again, of course, you can go buy silver. But look what happened to any trader that bought silver on the Sunday night open. Right? The reality is if you bought silver on the overnight open, it was horribly volatile. Okay, if you sold the S&P 500 on the overnight open, it's just rallied 100 handles. Okay, you can't manage risk in those situations. So again, we use the volatility in GME, in SLV or silver. We use that volatility as a proxy for spreading out in the other markets, and that's what I'm showing you here. Okay, so again, what we've got, silver in purple. Okay, we can see silver's traded back to the high of 2020. Okay, double topped. Now, does it go higher? Does it go lower? Who cares? Who honestly cares? If it goes above the 30 mark, and if it starts to sustain a bid, and if we're trading 31, 32, 33, 34, then it matters. Why? Because we know that's going to spread out into the other markets. And if it spreads out into the other markets, that's opportunity for us. How is that opportunity represented? I'll show you that in a minute. Okay, but the reality is, think volatility, think risk off, think where am I going to get my best bang for buck in terms of structure, and I'll show you that in a moment. Okay, the one they're talking about, the big Reddit market mover, the one they're all fixated on, is this one called SLV. Simply put, it's just an ETF. Okay, it's an ETF of the underlying. In other words, if you go all and buy the share today, you buy SLV, okay, the ETF has to physically buy the underlying, in theory. Okay, whether they do or do not, again, opinion, who cares? But the result is if we break out above that 25, 26 marker, which we are expected to do today, okay, then you're going to see ETFs start to rush for the physical because they're going to have to go and physically buy the underlying. Okay, now yes, over the weekend, not enough physical. We know all of this, right? We don't have to follow Reddit. We don't have to follow Twitter. What we follow is the price. If silver gets above, like I said, the 30 mark and it sustains a price above there, it's going to feed off into the other markets. That is why we're looking at SLV. We're not buying, okay, we are buying SLV. Make no mistake, I've got a couple of shares of SLV, not because I plan to become a millionaire, right? But because it's a shit and giggle gamble. It's fun. Okay, it's a little bit of adrenaline rush. It's like being in a casino. If I lose the money, okay. If I double the money, okay. Who cares, right? The real money is to be had in the other market. So we lean on the SLV as a proxy market, okay, i.e. correlations. So we lean on the correlated markets. Now, that's where we're going, okay? Two things to point out. I tweeted. Go look at my Twitter handle, okay? There's a lovely little tweet there from Habitus Capital. And that tweet is all about the chart of looking at US bonds last week and looking at the higher yields. Now, in a nutshell, what you're looking at here, VIX in green, you know what the VIX is. US 10-year yields, i.e. the US 10-year bonds in the orange, and the US 500, S&P 500 in the purple. Now, I pointed out on this tweet, and it's important you understand this, whenever we see bond yields and the S&P 500 price move in the same direction, right, it tends to spur on more volatility. Why? Simply put, when there's risk off in the market, when there's a little bit of panic, portfolio managers tend to want to buy protection, insurance. Okay, think of the VIX. Basic nutshell. It's not as simplified as that, but in a basic nutshell, they want to buy protection. Okay, now, when that protection is expensive, like it is now at 30, the reality is they're not going to pay up for that protection. So what they tend to do then is unwind some of the portfolio, take a little bit of profit or get rid of a bit of some of the positioning in the equities. All right. Also, they tend to go and buy the safe haven assets. Think yen, Swiss franc, think dollar, think US 500, US 10-year bonds. Okay. So they lean on some of the risk safe haven asset classes. But the problem is when those safe haven asset classes don't respond like they should, technically they're going further offside. Okay, and that's what we started to see on Friday, which is huge. Okay, US bond yields rose all the way back to 1.1%. Okay, at the same time, the S&P was down 3.5% last week. Okay, that is significant. Why? Because, like I said, if we look at the chart, note every time we had that correlation moving together, and that's what these gray little dotted lines are. Every time bond yields moved higher and the S&P price drove lower, we saw a heightened period of volatility. Okay, not necessarily higher volatility, but a heightened period of volatility. Okay, now remember, heightened period of volatility just means that price is going to move around in a greater range. Okay, and that's very important to understand for this week because, like I said in the tweet, we're expecting, based on the technicals, we're expecting the S&P to drop a little bit lower this week. There's still a good 3 to 5% downside technically, okay? Technically, and I'll show you what I mean by this in a minute. Now, two charts, two opportunities. This is where you got to look this week, okay? Number one, US dollar, right? It's got significant short positioning, right? If you're not following the CFTC report, you need to catch a wake up. There are significant shorts in the dollar. A lot of hedge funds leverage short positions. And what we can see is the famous head and shoulders or inverse head and shoulders pattern. Dollar index is orange and the euro dollar is in purple. So we can see left shoulder, head, right shoulder, neckline is around this 91 mark. Huge point in the market, okay? Significant point in the market. We tested it and probed it very early on this morning. A little bit of volatility came in if you're watching. So note the market's paying attention. Okay, we get above that 91 and you're going to see a rush for dollars. All right. Now, ask yourself this. If you go look at the dollar, and I'm not going to do this chart right now, but if you look at the dollar over the last couple of weeks, whenever there's a little bit of risk off, we're seeing money come back into the dollar space. Okay. Remember what I said all about GameStop and all about SLV. All right. It tends to create volatility. So if you get any kind of a move about 30 in silver today, or GME suddenly starts to gap up, bang, Dollar longs, that's where the play is. Why? Not because Brannigan says so, but because 91's huge. There's massive resistance there, and there's a lot of short positions that are playing, for a lower dollar. So we get above 91, you're going to see a squeeze in the dollar. You're going to see forced profit taking. You're going to see the momentum players come into the market. Okay, so there's your first play. Now, one of the ways you can expose yourself to that, yes, you can trade the dollar index itself. You could trade any one of the dollar products. But the one product I really like, and I've been banging on about this for a couple of weeks now, is the euro. Okay, we can see over the last couple of weeks since the beginning of the year, a little bit of a flag formed in the euro, and we're now probing on that little double bottom. Arguably could also be called a little head and shoulders. Not too worried about that, but it's that key area of 120.75, somewhere there. We get below, then you're gonna see again. There's a lot of long positions positioned for a higher euro dollar. So below 120.75, and you've got at least 200 pips to the downside before we start to see any kind of slowdown in the price action in euro dollar. Okay, so that's the first pretty straightforward opportunity. Now, whether or not it plays out, okay, who knows? This is what a thesis building is all about. We build the thesis, we build the opportunity scope, and when it comes, when it presents itself, when the silver's above 30, bang, we hit it. We put the size on, we take the risk. Why? Because the reward scope, the reward spectrum is significant relative to how much it's going to cost us to get exposure to that trade. And hopefully you understand, this is the lesson of this entire little quick, 15-minute video, is that yes, we can trade GME, yes, we can trade the SLV, but the reality is we don't know what the risk is in those trades, right? It's actually quite a wide risk because of how volatile it is. Right? And that's why we focus on something like, for example, the dollar. Now, the other one I want to point out is the S&P 500. Again, I've been sort of pushing for this trade quite a bit. The S&P is on the verge of a very decent breakout, and this is the chart. Okay, so this is the cash chart. And what we can see is that ever since November, the start of November, we've been just grinding higher. Okay, notice 1, 2, 3, 4, 5, 6 tests of this trend line. Okay, we broke below it, we closed below it on Friday, and we closed in and around that 50-day moving average. Now, I don't use moving averages for anything, it's just there. Okay, the reality is that this market technically is pointing toward further downside this week. Okay, this is just if I was just looking at the S&P, I'd be wanting to short this market this week. But when we factor that in with what we're seeing in the US bond yields and how they're moving higher, with what we're seeing in the silver market, what we're seeing in the GME and the volatility as a result, all of that points towards further downside in the S&P 500 this week. So those are the 2 points of reference that we're paying attention to. But again, remember what I said, we're leaning on the proxy market. Okay, we're not going to just preempt. We lean on the proxy market, lean on the GME, lean on the silver, and take advantage of it. Okay, guys, if you have any questions or if you like this video, tweet. Okay, go and tweet us. All our information is there. As usual, the Axia Trader is always very kind to post a lot of things. So do follow us. If you want more information about Axia, it is on the website. Otherwise, I hope you enjoyed this video. Feel free to reach out to me on Twitter, trader_Bran, and I hope you enjoyed this video.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.